Hello and welcome to Market Guru. Joining me on the show today is Vetri Subramaniam, Chief Investment Officer at Religare Mutual Fund. Thanks, Vetri, for coming by. It's always a pleasure talking to you. What's the mood looking like? There seems to be this sudden burst of excitement, positivity. Is it a little bit overdone according to you? Because on the ground, have really things changed?
Well, I think, Vivek, there's both good and bad news around here. The good news is clearly that, the change of guard is being seen as something which will hopefully energize the government and particularly the finance ministry. There are several contentious issues that needed resolving. And there is a sense now that, perhaps the government has got the message that the economy is in trouble. It requires serious action. And so we're seeing a lot more in terms of, talk from Delhi in terms of what they're trying to do. And given that there's a new person, not really a new person, but a new person in charge of the finance ministry, there's a little bit of optimism coming from that front. But as you rightly pointed out, on the ground, things are not easy, and I don't think any of that is going to change in a hurry very soon. It will take a while, even if some of this talk converts into actions, for it to really start having a very concrete effect on the ground in terms of helping the investment cycle or in terms of getting the economy sort of moving to a higher growth trajectory again. There are no easy solutions, but yes, the market does take a little bit of confidence and hope that there will be some policy action in the days ahead.
Vetri, in a recent note that you wrote to all your investors, you make the point that both cyclical factors as well as structural infirmities are contributing to the slowdown that we are seeing in the economy. I want you to elaborate a bit on that.
Yeah, I think the structural infirmities are actually something that I think we have ignored quite a bit in recent years. And I think the key issue over there is essentially the fact that we have followed a very loose fiscal policy. We have followed a fiscal policy which has unnecessarily stimulated consumption and has, whichever way you look at it, led to a crowding out effect, which has actually dampened the domestic investment cycle. Obviously, allied to that, we have the issue of the investment cycle, which itself has run into headwinds. Some of it you can attribute to cyclical factors like inflation, the high rates of interest. But a lot of it has also got to do with the fact that we are facing serious issues in the economy in terms of getting the investment cycle underway. And let me just give you a classic example over here. When we talk about the power sector and the fact that some of the projects are stuck up due to land-related issues, fuel-related issues, we are losing sight of some of the key structural reforms that still remain undone 10 years after we talked about reforming the power sector. Which is that essentially you're still not charging users what you should be charging them for power. The SEBs are bankrupt and they can sign as many PPAs as they want with the private sector. But every 3 to 4 years, if you're going to come back with bailout package number 1, bailout package number 2, you really aren't addressing anything at all. So I think there are a lot of these structural infirmities which have contributed to this slowdown, and they need as much addressal as do the issues of inflation, interest rates, and the global economy. So it's really a combination, and I don't think we can just single out cyclical factors for our current less than potential growth rates.
And what you're saying is that if we do not sort these out, then some of the experts who've already begun to question India's structural growth story perhaps would be right then.
Yes, I think the issue as far as India's structural growth story is concerned is that we are clearly growing below potential. Our potential rates of growth are much higher. But if we really want to achieve them, we need to make sure that there is an adequate supply side response within the economy. What does that mean? That essentially means that every time the economy tries to grow, we need to make sure that it doesn't encounter inflationary bottlenecks. These inflationary bottlenecks could be the fact that we don't have enough or proper roads, we don't have have enough highways, we don't have enough port capacity, we don't have enough power generation facilities, we're not doing our best in terms of exploiting our natural resources and wealth, and all of these then start to become inflationary bottlenecks, and eventually at some point the central bank is forced to slam on the brakes because inflation is starting to get out of control, and they're forced to drive the actual rate of growth down below what our actual and true potential could be. So if we really want to realize the structural growth rate, and we as a nation, we have very high aspirations, and we should have high aspirations for ourselves in terms of growth, it can't be done unless you address these structural issues in terms of the supply side bottlenecks. And unfortunately, all the supply side bottlenecks are in the domain of the government. Some of these issues are policy related, but very significantly, and I think Arun Mehra of the Planning Commission spoke about this on your channel a few days ago, these relate really to implementation and execution of projects. This is being tied up in unnecessary bureaucratic red tape, and this is what to my mind is really the true cause of a lot of our problems. Implementation bottlenecks. It's not just about the policy. Policy paralysis is a very popular word these days, but I think implementation bottlenecks are as important, and as Arun Mehra said on your channel, maybe even more important.
You also made the point about the fact that stubborn inflation is unlikely to allow the RBI to undertake any meaningful policy rate cut. What's your own view, Vetri, over the next 6 months? Therefore, what's the kind of scope, according to you, that exists? Because, there was a lot of expectations around this whole thing that by the end of this year, 12 months, some experts said 125 basis point, it went up to 150. We've seen 50 of that, but what's your own view, therefore, in the next 6 months?
There are two parts to the interest rate conundrum. Industry is obviously arguing for lower rates, but let's look at the facts. Inflation really isn't under control. Our sense is that at best the RBI, maybe during this financial year, can cut by 25 to 50 basis points. The recent weakness in global commodity prices is helping to some extent, but I don't really think inflation will come down too much in terms of giving RBI more leeway than another 25 to 50 basis points. But the other key argument that I want to make over here is, how do you guide interest rates down when the incremental credit deposit ratio within the banking system is running at 95%? You can look at the newspapers yourself. Large banks are offering 8% on 10-day fixed deposits. I mean, how do you get interest rates to come down when money is so much in short supply? So, it's one thing to talk about what you want the RBI to do and cut the bank rate, but if the fixed deposit rates offered by the banks are set at such a high level because the incremental credit deposit ratio is so tight, then it will be very difficult for market rates of interest to drop considerably, irrespective of what the RBI might try and do.
You've also mentioned that the one redeeming feature of the GDP data release was the slight traction in fixed investment, which you feel shows an uptake in the replacement capex. Can you explain that?
Yeah, I mean, I'd still be a bit wary of, over analyzing some of these government statistics. The RBI itself called it analytically bewildering. But our own sense, and this is really more driven by anecdotal feedback from companies, is really that companies are undertaking a fairly reasonable level of replacement capex in terms of refurbishments. Nobody has got anything very big lined up in terms of large greenfield capex, but there will be some sustenance level of capital investment that happens. Companies are hitting full capacity utilization in some business lines. Some of them have already announced capital expansion, and those spending plans are already underway. So we do feel positive that there is a little bit of visibility on replacement capex. But if you really want this economy to accelerate and get to those potentially 8-9% kind of GDP growth rates, then there needs to be far more that needs to happen. The current rate of replacement capex is not enough to keep this economy or help this economy to accelerate its rate of growth. It will allow sustenance, but will not drive an increase in growth rates.
Let me move now to the entire earnings perspective, Vetri, where you've, of course, when you wrote the note, you didn't have all of them, but from the you've said that excluding the oil PSUs, the broad market revenues are up 14%, while earnings are down 3%. Of course, you would be now armed with the most latest numbers. On the more earnings front, corporate performance front, how are things looking?
Well, I think the only good news about the earnings over the last 2 months has been that the FY13 analyst forecasts have not seen too many cuts, which suggests that we've reached a point where the analysts have already cut their forecast quite dramatically, and the performance numbers that are coming in are starting to match that. Remember that the growth rates for FY13 are anyway not very aggressive in the first place, but it just suggests that the issue of expectations versus actuals seems to have reached some kind of normalization. We finished the month of June, so in a few days' time, this result season will be truly underway again. Our sense is that you'll continue to see pressures on overall revenue growth. I think the revenue growth, what we've seen for a larger sample size of about 150 companies or so, is likely to be for this June quarter still tracking at just about 14%. Aggregate earnings growth for the sample is likely to be negative. If you look at the Sensex, it will most probably be positive, but just in the low single digits. So I think there's still a lot of pressure out there. I think the key thing when looking at the earnings numbers, two things that we are looking for. One is the fact that revenue traction is increasingly weakening, and the second is that companies are experiencing margin pressures no longer on account of things like raw material cost or all of that, but simply because there is intense competition for market share in every industry that we look at. Because this economy is growing below potential and people had already built up capacities for much higher rates of growth, the challenge that we are seeing in every sector is a battle for market share, and that is what is really putting pressure on the margins.
So how are valuations looking to you then, Vetri? Because again, you mentioned that we are now nearly 15% below long-term averages, trailing PE multiples, and they do offer comfort. Is that the view you still hold?
Yeah, I think so. We are in this market where there are two elements we can look at. One is the macro challenges, where the picture remains fairly worrying. It remains sort of challenging. On the other hand, the only good thing that we see is that a lot of this is captured in the valuations. The valuations are still at about 12-13% discount to historical averages. And we are only looking at trailing earnings these days because, frankly, the forward earnings estimates are something that are very questionable. So we're only looking at the trailing numbers. So at 10-12% cheaper than average, we still think we're in a reasonable comfort zone as far as valuations are concerned. There's every reason to be therefore sort of positively, or I would say sort of take a constructive stance towards equities when valuations are cheaper than average. I'll only make one point here, that as far as valuations are concerned, averages never tell you the whole story, and that's partly true of this average as well, because we've got one part of the market which can be sort of classified as the consumption related stroke defensive sort of areas, which are trading at a huge premium to the average, and at the other hand we've got more cyclical areas which are trading at a discount to the average. So it is a story of two extremes, and that is something that we are wary about now in our stock picking, because there is a limit to which you can really overpay for some of these consumption stories and so-called defensives when valuations have become so much more cheaper in other cyclical parts of the market. So we're really saying that a lot of the macro is in the price, it's in the valuations, the challenges are well known, it's reflected in the valuations. What you need to focus on now is the bottom-up stock picking. What you need to focus on is, am I getting reasonable valuations? Can this company survive another 1 to 2 tough years and come out of it? Because if they can, at that point of time, they will be very well placed to benefit from that growth. So balance sheet issues are what we are most still sort of cautious about, but otherwise we are far more open to sort of taking on risk even in macro sensitive areas.
So are you saying, Vetri, that before we actually start seeing the return of growth, we could go through a fairly prolonged period of pain, which could be at least 2 to 3 quarters from here on?
I think so, Vivek, and that's essentially driven by my premise that I made earlier, that what we are seeing today is a battle for market share. I mean, you're seeing this in every industry. There is more capacity available than there is demand. I mean, there may be a few exceptions here and there. And because growth is not meeting the aspirations with which entrepreneurs set out 2, 3, 4 years ago, and they built out capacities and business plans based on this, they are having to respond to this, and they are having to respond to it in many cases by battling for that market share. They're having to do things like cut costs, cut back discretionary costs. They're having to battle on price and therefore offer large discounting in many cases. So all of this essentially means that you're in an environment where As long as the economy grows below potential level, there will be a battle for market share, there will be a battle, there will be pressure on operating margins, and therefore these challenges will not go away even in the next 2 or 3 quarters, irrespective of whatever feel-good might come from Delhi or even concrete actions that they might take in terms of easing some policy bottlenecks. That will get reflected in the change in valuations, because that really reflects how we as financial investors are willing to pay for visibility of future earnings. But will the underlying earnings trajectory itself start to change in 1 or 2 quarters? I think not.
Vetri, you made the point as well that the less cyclical components of the market are trading at rich valuations, and pockets of undervaluation exist in the cyclical areas. And that's where you're probably open to investing. Of course, you articulated the fact that you would look at strong fundamentals, strong balance sheets, the ability to withstand the pain. But could you elaborate sectorally which some of these sectors would be?
Well, essentially, I think the challenges as far as valuations are concerned are most pronounced in the consumer staples area and other sort of allied consumption areas. It's also in the pharmaceutical area. These stocks are trading at a huge premium to the market. In fact, these sectors are trading in many cases, 1 to 2 standard deviations above their 10-year average trading multiples. So, in some senses, we're starting to get to a level where it's no longer about whether these are solid companies. It's no longer about whether these can generate healthy earnings growth over the next 2 to 3 years. They most probably can. But if this is your starting level of valuation, then can we as investors in those stocks at these prices earn a healthy return over the next 2, 3, 5 years by buying these stocks? The answer that we are seeing in many cases in these sectors is that it's unlikely, because if you factor in even slight risk of PE derating over a 3 to 5 year period, it would essentially wipe out most of the returns, and the positive earnings growth wouldn't count for much in that scenario. So I would say essentially, defensives and consumption related areas, pharmaceuticals, consumer staples, some discretionary areas, these are the areas where valuations are very challenging. Even interestingly, in the financials area, there is an issue over there where some of the institutions which are seen as being very strong, which have strong balance sheets, not facing too many asset pressures, are trading at, I would think, fairly premium valuations. And while one can take comfort in owning some of these names simply because of the comfort with their underlying balance sheet and asset quality, one does worry about the fact that at these multiples you might be challenged in terms of forward returns over a 2 to 3 year period.
We'll leave it there, Vetri. Thank you very much for joining us, like always, and sharing your perspective with our viewers.
Thank you.
All right, that was Vetri Subramaniam here on Market Guru. Take a quick break, but lots more coming up on Bloomberg UTV.
Powered by Reliance Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. In association with Randstad, shaping the world of work.
Is your money gathering dust? Now, give your money the attention it deserves. Reliance Mutual Fund, with 17 years of managing investments and 70 lakh investors. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Daily trading in Sensex derivatives crosses rupees 56,000 crores. Participate in the Sensex.
IMS Foundation, engaged in the overall development of engineering and manufacturing sectors in India, brings together a gamut of industries on the single largest platform. Reliance Broadcast Network Limited and Bloomberg UTV present IMS 2012. Book your space and get an opportunity to interact with global customers and industry leaders this September in Bengaluru.
If you're a first-time investor, frightened about that first move, planning for good old 40s, aiming to keep failures away, worried about those hard-earned savings, and puzzled about your choices, it's time to meet our experts, the Financial Planner, presented by BSE Investors Protection Fund.
Presented by BSE Investors Protection Fund.
Lower the market goes, it becomes a safer place to invest.
The Nifty is pretty close to the 5,000 mark.
That's what the flavor of the market is today.
Banking and capital goods are the most attractive sectors to play.
It is completely an out-and-out trader's market.
Countdown, presented by BSE Investors Protection Fund.
Presented by BSE Investors Protection Fund in association with the Cheetah-inspired XUV 500.
You earn money and invest it to better your future. But for what? To lose it over some unread fine print? That's not fair. I urge you to be alert all the time. And I promise myself and you to fight back for your rights.
Brought to you by Reliance Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Good morning and welcome to First Trade.
It's a good opening for the BSE mid-caps, 0.5% gains coming in.
How do you see the global situation?
Why is the euro falling? We'll get some answers.
For international investors, you have the dollar to go to. But for the US investors, where do you go?
First Trades, presented by BSE Investors Protection Fund.
Presented by BSE Investors Protection Fund. In association with Happy Legs in the stylish new Xylo.
Hello and welcome to Market Guru.
I think the bigger risk is growth rather than inflation.
We're going through a typical cyclical slowdown in growth.
What should investors be doing now? That's the billion-dollar question.
We are very bullish about the Indian IT sector.
And long-term picture is India is growing.
How deeper is the pain still to come?
Situation is bad, but it's still something which can be resolved.
In association with Randstad, shaping the world of work.
From the morning snack to the car that drives you and the watch that helps you keep time. From the search engine that gives you answers to the drink that adds a phase. From the TV that's your window to the world and the jeans that you chill in. From the tablet that you carry to the chocolate that you tuck in and the water you drink. These are the companies that touch our lives each day. But how much do you know about these companies? Join me, Minnie Menon, as I go inside some of India's best-known companies.
Time has come for rates to go down. This is the right time to cut rates and to cut CRR.
Market regulator SEBI has cracked the whip on 7 IPOs.
I am shocked at the audacity of the perpetrators of this offense.
The country can't do without an aviation industry.
I'm expecting 2012 to be better than 2011.
If you're a first-time investor, frightened about that first move, planning for good old 40s, aiming to keep failures away, worried about those hard-earned savings, and puzzled about your choices, it's time to meet our experts. The Financial Planner, presented by BSE Investors Protection Fund.
Presented by BSE Investors Protection Fund.
Hello and welcome. You're watching Market Pulse. On to the top headlines that we track this hour. With foreign investors remaining concerned on General Anti-Avoidance Rule or GAR, Prime Minister Manmohan Singh has stepped in. Bloomberg UTV learns that a high-powered committee is likely to be set up to review the guidelines put up by the Finance Ministry. That's a Bloomberg UTV exclusive. And as Kingfisher crisis worsens, its viability comes under question. Kingfisher management meets lenders today. And the spotlight on the European debt crisis shifts decisively towards ECB President Mario Draghi. Will ECB cut rates or not? That's the crucial question that we're asking. That's, of course, going to be the big cue for the markets as well. On the show, we also get to expert views from Jeff Lewis, Executive Director of JP Morgan Asset Management, on what he expects from the ECB meet today and the road ahead for Europe. Well, those, of course, are the top stories that we track this morning on Bloomberg UTV. It's a quiet day of trade coming in on this very rainy Thursday in Bombay. The markets are very quiet, pretty similar to what we've seen over the last 3 days. The Nifty trading around those levels of 5,300. 50 to 97 is what the Nifty is at. Remember, the last couple of weeks have been all about stocks. The Nifty has been stuck in a fairly tight range, but 5,300, remember, continues to be an important pivot for the markets as well. While equities are looking quiet and you're seeing a lot of stock-specific action, all the action seems to be in the currency markets. Once again, the euro, or rather, if I can call it that, it's a villain in today's trade. At least the dollar-rupee pair looking quite weak, down about 0.6%, trading close to those levels of 55, 54.85 is what it trades at after the nearly 5% gain that the currency has seen over the last couple of days. Well, a couple of smaller sectors in the markets that seem to be buzzing with action. One is retail. In fact, all newspapers today carry the top headline that FDI and retail could be coming in sooner than later. On back of that, Pantaloon, Arvind, Shoppers Stop are surging in trade. Shoppers Stop really leading those gains. Trent as well not doing too badly. In fact, all these gains coming in on very large volumes in the retail space. Well, rice as well is having a bit of a cheerful Thursday morning, if I can call it that. The government has removed MEP on basmati rice, of course, making exports a lot more competitive in terms of basmati rice. KRBL up 9%. Kohinoor Foods is the top gainer, up about 13.5%. LT Foods as well doing up about 8% gains in today's trade. Of course, all these gains are coming in on very, very large volumes. Well, that's, of course, the big market headlines and, of course, the top stories that we track. But another stock that evidently is in focus today, not for the right reasons, is Kingfisher Airlines. Their trouble continues. In fact, it gets only worse as you talk about Kingfisher Airlines. Viability now is a bit of a worry when you talk about the aviation major. Kingfisher Airlines will be meeting its lenders today, we believe, to discuss its financial position and its ability to repay loans. Swati joins in with more details on this story. Swati, what are you picking up from your sources? Another meeting, another big day when you talk about Kingfisher meeting its bankers. I don't even know how many times this has happened in the past, but what can we expect?
Well, that's right. In fact, like you pointed out, it is a crucial thing again because they are going to take a stock of the situation as far as the first quarter of the company's performance is concerned. Importantly, the equity infusion clause. I mean, remember, lenders have asked the management to bring in equity worth 1,500 crore rupees. Unless they do that, they will not pump in any money. We know that ICICI recently has sold off its exposure to Sri Infra for 450 crore rupees. Other lenders like SBI, IDBI, they are big ones there. Really looking out to what management will have to say on equity infusion. Otherwise, they will decide the future course of action. It's a clear, crucial meeting. All big lenders are there. CEO Sanjay Agarwal has just stepped in. So, this meeting is just going to start, and we'll keep you updated on what's going to happen.
Of course, we'll keep coming back to you for more on that, Swati. For now, that meeting is just getting started, but lots can be expected in terms of what really comes out of this meeting. Remember, it is a number of meetings that Kingfisher Airlines has had with its bankers in the recent past. Things aren't looking great. The troubled airline clearly facing rough times as we speak. Well, the promoter holding, remember, in the Vijay Mallya-led UB Group's Kingfisher Airlines has dipped to a record low now. So, of course, as we take a look at what's happening, there's been complete wealth erosion, if I can call it that. The lowest, in fact, since Kingfisher Airlines, or rather Deccan Airways, was actually acquired. There has been wealth erosion, to be precise. About a year ago, Mallya's wealth stood at about 3,100 crores.